Have you ever looked at your balance sheet and realized most of your net worth is tied up in a business or an equity position you can't actually access? On paper, you're winning. In real life, you're still waiting. And the longer that liquidity event gets pushed out, the more risk and concentration you're carrying. Welcome back to another episode of the Vital Wealth Strategies podcast. I'm your host, Patrick Lonergan. And today's conversation is one I believe every founder, executive, and high-earning professional with equity compensation needs to hear. My guest today is Greg Brogger, founder and CEO of Collective Liquidity. Greg has spent over a decade at the center of the private markets, helping build the modern secondary market for private company shares, partnering with NASDAQ to create the NASDAQ Private Market, and now focusing on how founders and executives can unlock liquidity and diversification without lighting up a massive tax bill. In this episode, we break down why so many successful operators are unknowingly overexposed to a single outcome, how long IPO timelines increase both financial and tax risk, and how advanced strategies like exchange funds and structured liquidity can help you diversify, access capital, and defer taxes all at the same time. If your business is growing, but your tax bill keeps getting bigger and more unpredictable, this conversation is going to change how you think about planning. And if you're listening right now thinking, I just wrote a painful check to the IRS, this is your sign to stop reacting and start planning. We're currently taking on new clients for 2026, and the biggest tax savings don't come from last-minute moves. They come from intentional, multi-year tax strategy. To start that process, head over to vitalstrategies.com/tax. That page is specifically designed to help high-income business owners and executives understand where they're overpaying in taxes and what advanced strategies may be available to reduce that burden going forward. Again, that's vitalstrategies.com/tax. If keeping more of what you earn matters to you, that's where to start. And before we jump in, if you get value from this episode or the podcast in general, please take a moment to leave a review. It helps us reach more entrepreneurs who are asking better questions about money, taxes, and long-term wealth. All right, let's get into it. Thank you for joining us here today. On the podcast, we've got Greg Brogger, the founder and CEO of Collective Liquidity. I'm excited to get into this conversation because there's so many unique tax opportunities that Greg is going to get into today that oftentimes people in certain situations don't get to take advantage of. So Greg, thank you so much for joining us here.
Great to be here. And thank you for having me, Patrick.
Yeah, you're welcome. So I think about some of the problems, and we're thinking about private company and employees that have equity in these private companies, and their net worth is kind of locked up in there, and if I think of it from an investment allocation perspective, they're very heavy on the concentrated position that they don't have any control over. And it's like that can be somewhat scary, and IPO timelines can be uncertain. Secondary liquidity is often opaque and inefficient or unavailable. And so traditional advisors lack the tools to solve this problem. So I think that's an interesting external problem. Internally, they feel trapped by these golden handcuffs. They're great on one hand, but on the other hand, it's just this paper wealth that they in reality can't get their hands on, and they really lack freedom and diversification and flexibility. And they're probably worried they're overexposed to one particular outcome. Yeah. And then philosophically, we just think about the people that help create the value shouldn't be forced to gamble their entire financial future on a single liquidity event that they don't control. So I'm looking forward to unpacking all of these issues.
A lot there, that's for sure.
Yeah, very good. So Greg, can you give us a little bit of your background?
Sure, yeah. So I began my career as a securities lawyer at one of the Valley law firms, Wilson Sonsini, and it was a great way to break into the venture world and start working with boards and founders and executives, and learned a whole bunch about the way these companies are financed and how they look at issues around with secondary liquidity, and was an opportunity also to see that world, that sort of ecosystem, which at the time was very kind of focused in Palo Alto, Menlo Park, Sand Hill Road, and then just see these dramatic changes that happened over the next 10, 15 odd years. But just for me, and again, back in my background, I didn't really much enjoy being a lawyer. So I left the law just after a couple of years and went in-house to do business development for an incubator down in Southern California, just as the sort of .com bubble was inflating. So it was a wild ride of sorts, up and then down. But I did have the good fortune to connect with the co-founder, and we started a couple of companies. Really, he was the founder, I was the co-founder. Those companies had kind of small to mid-sized public exits back in the day. Um, but really, the relevant stuff, I think, for our conversation today and for Collective Liquidity was that in 2009, I started a platform called SharesPost. And that was the first online marketplace to buy and sell pre-IPO shares of venture-backed companies. And that was sort of the right time, right place. That was when Facebook was still a private company, just on the edge of going public, and there were only a handful of what we now call unicorns. Of course, forward now there's 1,300 of them worth somewhere between $3 and $4 trillion or more. I think that number keeps going up, or I know that number keeps going up.
Yeah.
And so we did about $10 billion worth of total transaction volume across 350 names. It really kind of started the secondary market in this current, call it iteration, where you have the ability to connect with a buyer online and have a transaction processed. While at SharesPost, we did a couple other interesting things. So we did a joint venture with NASDAQ to create the NASDAQ Private Market. So I was the initial president or founder of the NASDAQ Private Market. And we designed the first tender offer programs. And that's still a significant source of liquidity to these companies today. Created a fund called the SharesPost 100 Fund, which is a little bit of a precursor to what we're doing at Collective, kind of a 1.0 version of what we're now doing at like a 5.0 version. And got that to, was ultimately a little over $1 billion in assets under management. And then probably last interesting thing, merged SharesPost into Forge, was on the board of Forge, so it went public by way of SPAC. And then just in this last month or so, it's been announced that it would be acquired by Charles Schwab. So we're really excited about that, to find a good home for that platform with the kind of resources and the foundation it needs.
Yeah, that's fantastic. And I don't mean to cut you off, but I just think of all of that background, I think leads so nicely into what you're doing at Collective Liquidity. You understand the private market and how to come up with a system for valuing those shares and all those other things. So I love that you just didn't go, you know what we're going to do? We're going to create a fund and go start acquiring these shares, and hopefully it all works out. So,
well, yeah, I mean, the problems you mentioned at the start of the podcast, right? The over concentration and the illiquidity. These are the two biggest problems in the venture world for the employees and founders of these companies. And it's been that way for a very long time. But back in the days when companies would go public after 3 or 4 years, most people can wait 3 or 4 years for liquidity, but now 10, 11, 12, 15 years or more, it seemed like a problem we're solving. So that's why I've been working on it for now better part of a decade.
Yeah. No, I love this. I think this is great. So can you give us, I think if it's okay, can we start with just maybe a case study on where this situation applies? Because we've kind of danced around some of the problems and the opportunities, but I think it'd be good to really start looking into, here's a fact pattern, here's what the problem is, and then how we can sort of unwind that problem tax efficiently. So there's obviously more than one variant, but a typical client of ours or LP of ours is someone who's maybe a founder or co-founder or senior executive at a company, a venture-backed company. They probably just, maybe cross over $500, $600 million in valuation, or maybe they're at $1 billion or more. Maybe they've been at the company for 5 or 6 years, and the company's knocking it out of the park. But just in this new world, the dominant strategy for when to go public is significantly further down the road. It's not $1 billion anymore. It's more like $2, $3, or $4 billion. In order to get the support from the leading underwriters and the support of the market, and for it to make sense for you to become a public company and take on all of that burden. So just one client that we're working with, they have 2 kids, and the wife is pregnant, is going to be delivering. They found a house that is the ideal, perfect dream home for them, but they don't have the liquidity that they need. And even though their company is doing really well, anybody who's been through a few different cycles has either been at a company that was doing really well and then did less well, or has heard, people's cautionary tales of what happened with them. And just to kind of put some numbers on it, we did this study that I think sort of confirmed what most people intuitively understood, but it was interesting to see in the numbers. So
we looked at companies, we compiled a list of every company that did a venture round, preferred stock venture round of a Series C round between 2010 and 2015, so a decade or more ago. And we looked at how many of those companies had exited since. It was only 38%. And so if you think about a company at a Series C round, that's usually a 50, maybe $100 million venture financing. And so the company's obviously been very successful and probably on a pretty significant path to value creation or to an IPO or to a sale of the company. And yet the majority of them don't exit or haven't, at least a decade later. And so, but here's the kicker. If you had invested in all of those Series C rounds, if you put $1 in all of them, your return would have been 5.03x. So the point being, and again, this is what everybody knows, is the winners of those Series C companies more than pay for the losers. But you have to think of it as an investor rather than employee. So there's a reason VCs have 15 or 20 companies in the portfolio or more. That's because the dynamics or the math of a diversified portfolio in such high risk companies is such that you need to be diversified in order to have confidence that you're going to generate wealth over the longer term.
Yeah. Yeah. And I think that's so true. And I think one of the things that we see in business in general is, it takes a great operator like that. That's just absolutely necessary. But there also is other factors involved. There is some luck. There is some economic opportunity. Where's the economy at? How are dollars flowing to different opportunities? Where is technology going? Are you aligned with all of that? And so, it takes more than just a great operator. And to get to the level that we're talking about here, you don't get to a $500 million or $1 billion or $2 billion valuation without operating well. So
a lot has gone right in order for you to be in that club, and it's the success story that everybody sort of focuses on. So I think many people just think that's normal, that's just pretty easy to do, just start a company, get to. But there's a lot of you're starting with a great idea. You have great execution, and you've got, I think the things that are, the luck factor, it's really about timing, right? Because everybody has a great idea, right? And just or almost everybody, but the ability to execute it and bring it to market at the time when the conditions are right and you can raise capital and the product can grow, there's some good fortune involved in that.
Yeah, absolutely. Okay, so going back to our young family, they've got 2 kids and 1 on the way, and they're like, "Hey, we'd like to, recognize some of this value and get into our new house, right? For our growing family to do that." So, how does that work, and how does Collective Liquidity decide yep, this investment makes sense for us to move forward?
Yeah. So I mean, let's start at a high level and just kind of talk about what an exchange fund is. So Collective Liquidity operates the private markets only exchange fund. And so what does that mean? What is an exchange fund? So, these funds have been around for public company executives or for public securities since the 1960s. Eaton Vance manages over $500 billion worth of them. And there's the reason that call it a wealth management or tax optimization strategy, it's been around for decades and been so successful is that it offers a really, truly tremendous benefit, which is you can take a concentrated position. Let's say you invested $1 million in Apple, 10 years ago. Now it's worth $10 million. You want to allocate out of that. You want to de-risk your winnings. Obvious thing to do would be to sell that $10 million worth of Apple shares, but then you're going to pay tax on the capital gain. And so you'd be reinvesting on after-tax dollars, which is never where you want to be. An exchange fund allows you to take that $10 million worth of Apple shares and exchange it for a $10 million LP interest in a diversified fund, de-risking you without triggering capital gains taxes. And the longer you leave that 10 million, what starts as $10 million worth of Apple in those shares, those tax savings compound over time. But by the time you're 6, 7, or 8 years out, from the initial exchange, as compared to what you would have in the bank on an after-tax basis compared to just had you sold the stock, it can be 2-3 times as much, obviously, depending upon the rate of return in the fund.
Yeah.
And so, our thought was, look, if this makes sense and is such a proven concept for public company executives, and Morgan Stanley has one, Goldman Sachs has one, UBS, Merrill Lynch, Fidelity, Charles Schwab, then it should make even more sense in the private market. And so why is that?
Mhm.
That's because people are even more over concentrated, which means they're even more at risk. Therefore, they need diversification even more. And the appreciation on their shares going from $0 to $1 billion if they're a unicorn on their company value means that the value of that tax shield is even more important. And if you've got really modest return, then the tax advantage isn't that great because your gains aren't that great. But if you've got huge gains, it means you've got a huge tax if you sell those shares. So just the very highest level, this seemed like a tool that, lots of people could use in the private market.
Yeah.
And so that's why we brought it to market.
Yeah, this is fantastic. And I want to step back and just talk through something that you discussed about taking my $10 million of Apple equity and moving it to the limited partnership, the LP that gives me diversification. Because the trick is like, okay, this is done really well, but we've seen businesses that have done really well over time that fall off, right? The scariest example is Enron, right? Like it was a darling. It was, AAA rated by all the rating agencies. It was doing fantastic. And then, the value went to zero. But we've seen other darlings. We've seen GE, which was a fantastic company. I think about, I remember reading Jack Welch's book. And I'm like, man, GE is where it's at. And it seems like since Jack Welch has left, GE's been on this slow decline, and it's like, capturing that appreciation when the markets, when the value's high, is important. And then I can diversify out of that, that risk. Because if we look at what the markets have done compared to GE since sort of that high point, I haven't done a deep analysis, but I'm guessing the markets in general, diversification has won in that scenario. And so if I think about living in California and I sell my Apple stock, I've got federal capital gains tax at 20%. I've got Medicare surtax at 3.8, and then
state
at
13% in California.
13.3.
Yeah.
So I'm up to over a third of my gains are going to the taxing authority. And they didn't do anything. Well, I shouldn't say anything. They didn't do much to contribute to the value of that that position. They're just taking the dollar. So if I can roll those dollars into an exchange fund and be able to diversify my position, now I can just continue to grow my wealth. Maybe not at the same rate. There is a level of, if I want to be on the Forbes list, right, of a billionaire, I have to have a concentrated position and generally apply some leverage. Okay. But maybe I'm okay not being on the Forbes list, and I just want to live a very
or maybe
life.
There's a middle path, right, where you're not trading all of your shares for a diversified position, right? But you're trading, some, maybe I would guess kind of the average number for us, about 20% of the holdings is the ideal amount for people to exchange into the fund. And really, what you're doing is you're trading kind of a binary outcome, like you're putting it all on the roulette table in red or black. For putting a floor under your net worth that supports your family and your needs over the long term. Make sure you're never going to necessarily worry about, well, maybe not never, but your concern about paying your mortgage, et cetera, is greatly reduced or eliminated, but you still have this significant upside. And so that's where I think that really has resonated with most of the founders and executives that we've talked to. They still believe in their company, but as you said, like what happened to GE? It's even more true in the venture world because I think the world is just becoming less stable from a business point of view with AI and quantum computing. I mean, this the latest technology. Nobody can really see where things are going to be 5 years down the road, and that's the exit horizon, or 5 or 10 years for many of these Series C companies. So no one can kind of see around the corners of the globe or that far out. And look, competitors emerge that you hadn't seen. Someone gets in the business that you hadn't anticipated. The technology moves. There's regulatory change. So again, anyone who's been around through a couple of different cycles, could probably list 10 different things or 10 different reasons that 10 different companies that they were sure, looked like the hottest thing and could do no wrong. Right. And it's not that they go to zero. Very few of them go to zero, but they just don't exit at any kind of appreciable gain over where they were at, say, that Series C mark.
Yeah. If today's episode is resonating with you, especially the conversation around concentrated wealth, liquidity, and tax efficiency, I want to give you a clear next step. Too many successful entrepreneurs wait until a liquidity event or a massive tax bill shows up before they start planning. And by then, most of the best strategies are already off the table. The real advantage comes from getting ahead on the problem and building a proactive multi-year tax strategy that's designed around your business, your income, and where you're going next. That's exactly what we help you do at vitalstrategies.com/tax. It's where high-earning entrepreneurs and executives can start identifying where they're overpaying, what advanced strategies may be available, and how to intentionally retain more of their wealth they're working so hard to build. If taxes feel unpredictable, frustrating, or bigger every year, don't wait for another surprise. Visit vitalstrategies.com/tax and start building a real strategy instead of reacting to the numbers after the fact. Yeah, this is fantastic. So just to continue this story along, I take, let's say, 20% of my my equity, and I'm ready to buy my house and take some chips off the table, help. So can you walk us through that process? Because how do I take the cash, and then I assume those shares then go into your exchange fund?
Yeah.
Can you walk us through?
Well, yeah, an important point. So we really, as I said at the beginning, there's two problems to solve. There's overconcentration and there's illiquidity, right? These are the perennial twin pillars of the venture economy dysfunction. And the exchange fund really only solves the first problem, right? So the exchange fund itself alone does not provide liquidity. What it does is it provides diversification. So I used to own $10 million worth of SpaceX. Now I own $8 million of SpaceX, and I have $2 million in a diversified fund. To provide liquidity, solve that problem, we've done a bunch of different things, and we're always in the market looking for kind of the next sort of, I'll call it credit facility. But I'll just tell you where we started and can tell you where we are now. So we partnered with WebBank, which is a prominent kind of fintech lender. And we said to them, look, there are providers out there, private credit funds that will lend against a single stock position, but it's risky for the lender. It's a lot of work to value these companies on a one-off basis. They have to get information from the company. And it's a challenging product that takes, weeks or months to get to. And for that reason, the loan to value ratios were very low and the cost of that capital was very high. So what we were able to persuade WebBank of was, look, when you lend not against the shares that the person came in from, but now you're lending against the LP interest that we've issued. That's diversified. It provides quarterly liquidity. It is priced in an automated way using an algorithm based on market pricing data that's updated in real time. And so we were able to get them comfortable with a significantly higher LTV and a significantly reduced cost of capital. And so that solution, we've actually exhausted the capital in that facility. And so now we went on to another one, which is more of a forward purchase. And so we can go into the details, but essentially what we're out in the market doing is trying to find sort of the representative of our community of founders that own interests, executives that own interests in our fund, looking for the best possible credit terms at whatever time frame we're in now. So the WebBank arrangement was something we entered into when interest rates were very low. So that cost of capital is very low. We've seen, obviously, that's changed. So, that's our pledge. We'll continue to talk to different banks and private credit funds to find the best solution for them.
Yeah, thank you. And thank you for highlighting an error you didn't highlight it, but an error in my statement was, I received capital. Well, I can't just take capital because now I've recognized my capital gain and I'm paying tax on those dollars. So it's like, I have to move my dollars into the fund and then and that was my thought was, okay, like we use securities-backed lines of credit on, investment accounts, you just highlighted how that could be done here. And it sounds like that's something you're continuing to explore.
Well, and to take your example, just to kind of make it or simplify it, I'll just use the WebBank program because we've talked about it. But if I've got $100 worth of shares or $100 worth of gain in shares, I could sell them and pay 46% state and federal tax in California, probably paid 4, 5, or 6% to the broker that found me the buyer. I'm going to net less than 50 cents on the dollar, and then I can go buy diversifying assets with that. But that process takes weeks or months. By comparison, you can come to Collective. You can do the exchange for $100 worth of share value for a fund. And then the WebBank program was at a 60% LTV. So I net more money up front. The loan is tax-free. The exchange is tax-free. So not only did I get more money up front, but I also have this appreciating interest over time in the fund.
Mm-hmm.
Ultimately, when I'm ready to down the road, I can redeem that interest in the fund for cash, use the proceeds, pay off the loan, and come out way ahead.
Yeah. Yeah, that's great. Now you're just opening up the next level for me. So how do I exit the fund? What is the opportunity there?
So the exchange fund is an evergreen fund, and we do quarterly redemptions after a 3-year holding period. So the public exchange funds, this might be, you have a sophisticated audience, so I'll go into a little bit more detail.
Sure.
But the public exchange funds take advantage of an IRS rule that says if you hold your interest for 7 years or more, when you get a redemption in the form of securities, publicly traded securities, that's tax-free too, which just becomes the most amazing, tax benefit of any call it product or wealth management strategy that I'm aware of. We felt that, even though we provide liquidity up front, our LPs, the employees of these unicorns, would be, less comfortable with that kind of long holding period. So we made our holding period only 3 years. But that's something certainly we advise people to consider when they come into the fund, and then we pay them out in cash. And so one of the things that necessarily brings to mind, and kind of an important innovation we think to our model, is, well, how are you valuing our LP interest when it's time for me to cash out? Like you gave me a price on my shares when I came in and ascribe a value, but what is that? How's that, relate to, 4 years down the road when I want to take cash out of the fund? And so we developed an algorithm over the last couple of years that takes in all of the secondary trading data, primary financing, where other funds are holding it, the shares on their books and records, public market comps, private market M&A comps, basically everything, every kind of data point that a venture capitalist or investor would consider relevant to valuing the shares at a particular moment in time. And we built that into an algorithm. We get transaction data from all the major private market trading platforms integrated into one value. And then we use that value to price the shares on the way in, and we use it to value the portfolio on your way out.
Mm-hmm.
So it's not, really something that could be gamed because it's basically, an algorithm that runs mathematically based on market data. So, you're going to capture the full appreciation in the portfolio, hopefully that 5.03x return that we talked about earlier in the show.
Yeah, that's fantastic. And one thing that just to bring a lot of these things together, I think your background in, I believe it was SharePost and, all of these different, we'll call them, pre-IPO businesses. I think that just lends itself so nicely to what you're doing here at Collective, just because you've got a strong background in value and valuation, how we value these companies, how we create liquidity. I think all of that is just so important, and the transparency for the people making this major decision is critical.
Well, it's sort of embarrassing in a sense, because basically that I'm still working on the same problem I started working on 10 years ago just means I haven't done too well at solving the problem. But hopefully I've learned from the mistakes. And look, the market is more liquid as a result of some of the platforms that I've been involved in than it was previously. Certainly, before SharesPost or NASDAQ Private Market, that is injected billions of dollars into the ecosystem. But this just as a measure of how far we've come, right? The kind of the volume and secondary markets and liquidity is increasing at, call it a linear rate, but the value of the asset class is increasing geometrically. So if you have a $4 trillion asset class of late stage venture backed companies, and what I think most estimates are something like 50 to 100 billion traded last year. It's a big number, but as a percentage of the asset class, it's really just kind of scratching the surface.
Yeah.
So, we know from those numbers, or just, talking to clients and anecdotally, there's it's an enormous trillions of dollars worth of trapped equity value in these companies. And so it seems like it's a problem worth solving, even if we haven't gotten it right yet, or maybe until now.
Sure. And I think, I don't know, I just look at the marketplace in general, and not that you haven't got it right, you're just refining your process to make it better, right? And then that's the goal of every business, is let's just keep refining to be
Yeah.
more efficient, more effective, bring more value to the marketplace. So
Yeah.
I'm going to give you
Sure.
a little grace there and be like, hey, I think you're doing a great job.
Okay.
It's just finding new ways to bring value. So good for you.
Cool.
Yeah. Um, all right. This is fascinating. Is there? I'm just looking at this, going, okay. Um, I'm holding a concentrated position. There's risk in that. I may not. I think you're creating liquidity for people being able to exit after 3 years. That may not be the case in
Um,
their current environment, which I think is unique. You're also creating liquidity with the opportunity to borrow against the shares, which I think 60% is a fantastic number. Oftentimes we see with security-backed lines of credit for equity positions, 50% sort of the upper limit at times. So that's
well,
good for you.
yeah,
Yeah.
no, that's gonna vary,
Hmm.
credit partner by credit partner.
Right.
But that's,
Sure.
as I said, we're always trying to get the highest LTV at the lowest possible cost
Hmm.
to our partners.
Sure.
And
Yep.
that's, we've had some success there.
Yeah. Yeah. No, that's fantastic. So I'm just thinking through this. Is there anything else we should be thinking about? Is there anything that you know when we're thinking about the potential problems
Mhm.
that could pop up for somebody that is exchanging their shares into the LP that maybe they don't think about on the
Yeah.
front end? Because this is sounding awfully attractive
Yeah.
from
So too good
my
to be
point
true.
of view. Yeah.
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 Well, so, I think the thing that, after people, they've absorbed the excitement around the tax savings, naturally the question becomes, well, what am I investing in? Like, I know what my
Mhm.
company's worth, and I'm super excited
Right.
about that. And I've got, great investors, and I've got traction in the market, et cetera. But what are all these other companies? How do I get comfortable? Because, right now we're working with 30 different companies in the portfolio to provide liquidity and diversification to their employees. But, we'll probably be at probably 60 or 70 companies by the end of next year.
Hmm.
Um, and so what are those companies? How do I have confidence that, my company is not the star of your portfolio, and there's a bunch of other not so high performers. And so the returns that I'm hoping to get just never materialize. And so
Hmm.
we take a pretty disciplined approach to our portfolio construction. And in a sense, it's the most traditional thing that we do. So we have an investment committee that each week will review, 2 or 3 companies put in front of them by the investment team for eligibility for exchange. Because one of the
Hmm.
biggest problems to solve with an exchange fund, and we've seen this historically in for the public market versions of these, is the problem of negative selection bias. So the person who most wants to exchange shares in the fund is the person who's least confident about their future value.
Hmm.
And so we need to make sure that we don't let that happen, or very, very rarely let that happen. And so the way we do that is by applying a pretty rigorous filter. So one, companies have to be of a certain size, so $400 million or more, but the average size of a company in our fund is a little over 2 billion. And that there's some safety in that, just because these are obviously not really startups at this point, but they've got product, they've got revenue, they've got, real financial metrics that we can understand, and see that there's traction in the business, and the
Hmm.
likely growth. We look for or require that there be certain VCs. So we've got a list of, all the kind of usual suspects, top
Hmm.
decile VCs, that you would anticipate, and that gives us a confidence that that valuation that we're using as one of the primary inputs, the venture the primary financing valuation, was set by somebody investing 50 or $100 million, or putting real capital to work, had real expertise in understanding the company, was motivated to negotiate on behalf of all investors, with some vigor. So we can
Hmm.
trust that valuation, and that means that we can trust that that company will have access to capital go forward. Because if, you know Benchmark is putting in a $25 million check today, then they're going to make sure that the company has enough runway to reach an exit. And then we also, we avoid companies, making them eligible for exchange, that have really kind of binary outcomes, right, or
Hmm.
asymmetrical downside. So biotech companies, typically are going to be very valuable or not valuable at all.
Yeah.
So it's not to say we've turned down a bunch of very exciting companies, but we are not biotech investors. We're really relying on a diversified fund. So we're building more something that looks like an index, than something that is a stock pickers, like we're going to bet it all on this company because we've done a huge amount of work on it and we believe in this stock. And so similarly, we don't invest in crypto. We do invest in blockchain companies, but not in
Yep.
Tokens. And so that's one aspect. We don't invest in highly leveraged companies. So you get the idea. What we're offering our partners, our exchangers, our customers is the ability to de-risk their position by investing in some venture portfolios that can be expected to generate venture-like returns.
Yep.
But it is not a swing for the fences. It is not a spray and pray on early stage companies. So that, we publish the number, our target returns at a 15% IRR annually.
Yep.
I personally hope and expect that it will be more. It seems like we're heading into, really good timing right now for us in the market. We talked about good fortune. So we didn't always think that in 2022 and 2023.
Yeah.
But now in 2025, it's starting to look like things are coming together.
I love it. Yeah, Greg, this has been great. So I'm just going to recap a few things that we've talked about. We've highlighted some of the problems as a founder or executive at some of these companies that are on, taking VC money that are, have a nice valuation, but a lot of my balance sheet, my net worth is held in this illiquid stock.
Yeah.
And so you create an opportunity to diversify that risk and also create some liquidity, which I think is incredible. And if we think about what happens if we do nothing, you remain concentrated, illiquid, and exposed to a single outcome, which can be, when we've got years of investment in this value creation, that can be a little scary. But if we think about it on the other side, if we take action and we go, all right, let's diversify a piece of what we're doing here, create some optionality, some peace of mind. And then wealth can become intentional, right? Like I can be more focused on where I'm taking my dollars.
You can afford risk, right? You can afford to take risks. You can say, I'm going to stay private another 2 or 3 years because my whole financial life I've got a floor. And so therefore I can really optimize the shareholder outcome for myself and for my investors as well.
Yeah. Yeah, no, I think this is great. And so I think, talking through next steps, I think this conversation is a great place for people to start. But going to collectiveliquidity.com and just on your homepage, there's opportunities there for people to connect with your team or even have their shares valued. And I think that's a fantastic place to start. I think your website's well done. It's well organized. I think people should spend some time digging around on there and just it's a great place to start and understand this process and figure out so do I qualify, what are my shares worth, and then I think connecting with Greg's team is a great step. So,
just one other thing I'd say is just if as you said, there's an automated path through the website where you can get information about the value of your shares, what our bid price would be, kind of right up front without talking to anybody. But excuse me, for lots of people, they're nervous and a little bit, unfamiliar with the private market and how it works. And all I'd say is that when you talk to people on our customer representatives, they're happy to be really more consultants to you. And if our solution isn't a fit, if they think a brokered sale makes the most sense, or we know every broker in the market, we get data from every broker in the market. And so we'd be happy to refer you to, with the best person we can think of for your particular situation. So we're happy to help.
Yeah. No, this is great. And I love that you've identified this niche in the marketplace that's unserved. And the fact that you're the private markets only exchange fund is fantastic. So, and I think your background just is well positioned to bring value to people in this space. So
we hope.
This is good. Greg, is there anything else we should touch on before we wrap up?
No, I just wanted to thank you. I mean, you kind of led us through a conversation. I think we got kind of all the major, at least high level points out there. So, thank you very much, Patrick.
Yeah, no, thank you. And I just think about what success looks like in this scenario. The entrepreneur or the executive is no longer trapped by timing or market cycles. They've got clarity around their liquidity and just confidence in their entire financial architecture. And I really do love tax efficiency, and what you're doing here is a fantastic way to really create wealth in a tax efficient manner. So, Greg, this has been great. Thank you so much for joining us here today.
Thanks, Patrick. Cheers.
Thanks. All right, that wraps up today's episode. Thank you so much for tuning in and spending part of your day with me here on the Vital Wealth Strategies podcast. I hope this conversation gave you real value and a new way to think about liquidity, concentrated risk, and how tax strategy plays a critical role in building long-term wealth. This episode sparked a shift in how you're thinking about your business or your finances. I'd encourage you to share it with someone who could really use this information. And if you're listening and thinking about your own situation, especially if taxes have been a pain point, this is your reminder that the best strategies are built before the tax bill shows up. We're currently taking on new clients for 2026, and now is the time to get ahead instead of reacting. You can start that process by visiting vitalstrategies.com/tax. That page is designed to help you identify opportunities to reduce taxes, protect more of what you earn, and build a more intentional strategy going forward. Again, that is vitalstrategies.com/tax, and it's the best next step if you're serious about keeping more of your hard-earned money. If you enjoyed the show, please take a moment, leave a review. It helps us reach more entrepreneurs who are asking better questions about money, taxes, and life, and allows us to continue bringing these conversations to you each week. And remember, you're a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities, driving growth, and making an impact. You're vital to your family, creating abundance in every aspect of life. You're vital to me because you're committed to growing your wealth, leading with purpose, and creating something truly great. Thank you for being a part of this incredible community of vital entrepreneurs. I appreciate you, and I look forward to having you back here next time on the Vital Wealth Strategies podcast, where we help entrepreneurs minimize their taxes, master wealth, and optimize their lives.